Hello, I'm Tony Marino, President and CEO of Tenaz Energy. Thank you for joining us for our discussion of our second quarter 2025 results. Please note our advisory on forward-looking statements. A brief update on our NOBV acquisition closing. We closed this acquisition of NOM Offshore BV on May 1st. That was 2 months ahead of schedule, and a really great effort on the part of our staff at Tenaz that was involved with that, and the former employees of NAM who are now with our company. Upon closing, we renamed NOBV Tenaz Energy Netherlands. We'll refer to that from now on as TEN. So TEN has the offshore assets that we bought from NAM. This is distinct from our previous non-operated position in the Netherlands, which we still carry independent of TEN in other corporate entities, and we report some results for those in our Q2 report. In Q2 25, we have 2 months of results included for TEN, May and June. So these 2 months, for example, will add into the FFO that we report. For production rate for the quarter, we add together May and June, and then we divide that 2-month sum into the 3-month quarter to get an average rate for the quarter. April, prior to the closing, with respect to all the financial numbers, was a adjustment to purchase price, and in the case of production, does not get recorded within the Tenaz rate. With the free cash flow that we made from the effective date for the transaction, starting January 1, 2024, until we closed it on May 1, 2025, and other adjustments at closing, we received approximately 15 million euros in cash at completion from the seller. And finally, NOBV reserves, as we reported at year-end 2024, were 55.7 million barrels equivalent, 99% TTF gas. These 2P reserves, per that independent assessment by McDaniel, had a ATAX NPV 10 of 618 million euros, translating to $967 million Canadian. On to our operating and financial results for Q2. Production averaged approximately 8,000 BOED, up 176% from Q1 25. Of course, the reason for the large increase primarily driven by recording the 2 months of production for TEN after closing. First, looking at Canada individually, we will point out that production increased quite a bit, 19% above Q1 25, really driven by the new wells that we drilled during the first quarter, partially offset by natural decline. These 3 horizontal wells, all unfracked, 2 of them multilaterals, are strong producers. They're producing at a rate of around 1,000 BOED gross, which is 870 BOED net to Tenaz, with a 63% oil weighting in that net production rate. So 3 gross wells, 2.4 net, varying rates, and as a result, we end up with a fairly high net interest in those, on a production weighting, in those 3 wells drilled. In Netherlands, in the second quarter, we recorded production from TEN of approximately 5,000 BOED. Again, that's 2 months of results, April and May, divided into a 3-month quarter. Production was lower than the typical run rate that we would have at TEN because of major turnaround activity. We did a 21-day turnaround at the Den Helder gas plant and also had the associated offshore platforms down during that period for maintenance while Den Helder was also undergoing maintenance. We're very proud that we conducted those turnarounds, which were pretty complicated endeavors, safely and within our forecasted timelines. That generated this 5,000 BOED for the quarter, again using 2 months of counted production due to the downtime that we had during the turnarounds, and as expected production rate for us. The earlier pre-existing non-operated assets that we have in the Netherlands produced at a net rate of about 775 BOED, almost entirely TTF gas, which was down 20% from Q1, again because there was also 18 days of planned seasonal maintenance that the operator did on those assets, down only 2% from the year earlier period in Q2, really reflecting natural decline. As far as our CapEx program for the remainder of the year, it's as we reported previously at the time we closed the acquisition. It's our intention to have a barge and a drilling rig operating during Q4 25. There's a great deal of advance activity that is required to bring in this equipment and to begin the workover and drilling activities that we intend. A lot of long lead items to order. There's a lot of well-designed planning. There's permitting and partner approvals to get, so it is kind of a long process, but we are confident that we can get started on each of these during the fourth quarter, and we're looking forward to the results. We think there's a great deal of potential within the asset set in the existing well stock and with these new locations that we will begin to drill, and we're very anxious to begin that activity. Let's look at our financial results for the second quarter. We reported FFO of $17.2 million. That's up substantially, $16.3 million over the first quarter of 25. A big factor here was recording 2 months of FFO for 10 of $23.5 million. That 10 FFO was partially offset by $6.8 million of transaction costs. These were some of the transition activities required to close the deal and to become operator of the assets. During the second quarter, we recorded quite significant net income, $188.6 million, or $6.73 per share. This compared to net income of $1.3 million, or 5 cents a share, in the year earlier period. The significant net income was driven mainly by recognition of a $192.2 million gain on acquisition of NOBV. This is a comparison of the estimated value of the assets as compared to the liabilities associated with them. At Q2, we also made an estimate of our net debt position, which includes the estimated go-forward value of the contingent earnout that we owe the sellers. The total net debt position was $100.2 million, and that includes a contingent earnout, both short-term and long-term, totaling $89.3 million. I'll cover it again in just a second, but the short-term portion of that refers to earnout payments that we would estimate that we would make for 2025. The long-term portion of it would be estimated earnout payments for 26 and 27. Of course, the actual amount of the earnout is going to depend on our production levels that we record during this period, prices, and costs for TEN. So that is our estimate as of now, and we put that full estimate on our balance sheet into our net debt position. Finally, the NCIB program continues. The renewed program allows us to purchase up to 2.5 million additional shares. We retired 210,000 in the first half of 2025, average cost of $14.76 per share. Since we began the NCIB in Q3 22, we've retired 2.3 million common shares at an average cost of $3.90 per share. On the right side of the slide, we have a waterfall showing our net debt position that we estimate at the end of Q2. First two items we are referring to as short-term liquidity that represents restricted, unrestricted, and restricted cash. We then make a reduction for all the other working capital items, both positive and negative, and which includes the short-term portion of the earnout associated with our estimate for 2025. There's an additional $35.6 million that comes off for the long-term portion of the earnout for 26 and 27, again, estimates as of right now. We have $138 million of Canadian senior unsecured notes, which brings us to our adjusted working capital or net debt position that we report of $100.2 million as at Q2. Now, as we have done in previous quarterly reviews, let's take a look at the Tenaz record since recapitalization of Altura in 2021. First of all, now including the 10 assets, production is up 13-fold since the recap. FFO up even more substantially, about 40-fold from what we had at the time of the recapitalization, and share price with a TSR of about 946% since the recap. In summary, the model of the company stays the same. We still see a sizable market opportunity going forward with our acquire and exploit strategy. We think that the international assets, international regions that we're pursuing this in are good ones on a go-forward basis, as they have been already in the history of the company, with attractive multiples at entry and a greater opportunity than we would find in North America to improve operations. We continue to focus primarily on Europe, with also, we think, meaningful opportunity in Latin America and optionality in regions such as MENA, and perhaps there can be some around our existing assets in Canada, but clearly an emphasis on Europe first and foremost. We're a very technically focused company. We think we have a good record in adding value with M&A and in running the assets after making these acquisitions. A large, total transaction level in the history of the management team and the company, and the ability to apply these assets within a public markets model. And the Tenaz team, all of the employees in the company, are fully aligned with shareholders. We were investors in the recap, and we in the management, and again, every employee in the company are incentivized to deliver for shareholders. Thank you for your interest in Tenaz. I'd ask you to note the disclaimer that we have at the end of the presentation as well, and we look forward to talking to you again when we release our Q3 results.